Hey everyone, welcome back to Corporate Decoder. Today we're diving into Marvion Inc's latest 10K report. Get ready, because this one's a bit like a magician's trick. It looks impressive, but you might be left wondering where the rabbit actually is. We'll break down what this Nevada holding company with its Hong Kong operations is really up to. Think logistics, warehousing, and some interesting financial figures. Buckle up. It's going to be an interesting ride. First, the headline numbers. For 2024, Marvion reported revenue of about $1.5 million, which is great, but they also posted a net loss of around $733,000. Compare this to 2023, where they made a smaller revenue of around $660,000, but actually turned a tiny profit of about $9,000. So more sales, more problems. Let's find out. They've got a lot of shares outstanding, more than 340 million as of April this year. This can make each individual share less valuable. Here's a risk to keep in mind. Since they operate in Hong Kong, any changes in the Chinese government's policies could really mess with their business. It's like building your house on shifting sand. Also, there's a chance China could put restrictions on moving cash in or out of Hong Kong. That would make it tough for Marvion to use its money effectively or pay any dividends. And it gets trickier. Their Hong Kong operations might face restrictions on sending money back to the US. Since Marvion Inc. is a holding company, they depend on that cash flow. While we're on the subject of risks, consider this. The company's auditor needs to be inspectable by US regulators. If that becomes impossible due to some country restricting the inspection, there's a risk Marvion could get delisted from trading. Let's look at who's bringing in the big bucks. Proking International Warehouse Limited accounted for over $551,000 in revenue. The second one is Furniture Station Limited with $451,000. For 2023, they have a more diverse revenue stream, so their customer concentration is less risky. And watch out for land costs. Rising land values in Hong Kong could significantly increase operating costs. Even the data they hold is in a complex position, and they must comply with Hong Kong's personal data rules but are not subject to Chinese cybersecurity review. It seems all the business activities they have are legal in Hong Kong. They have a plan to secure land for longer agreements and keep a close eye on these costs. Navigating the tax landscape is like walking a tightrope. Changes in Chinese tax law and its interpretation could hit them hard. They also must comply with social and housing regulations and haven't paid fees in full. This can lead to significant penalties. When it comes to moving money around, they have to be careful with how they use their capital, especially with China's currency controls. F is the State Administration of Foreign Exchange, which administers things like the flows and convertibility of the Chinese renminbi currency. Plus, there's a chance the Chinese government could classify Marvion as a resident enterprise, which means they'd have to pay a hefty 25% tax on their global income. Ouch. Keep an eye on the SEC. They're asking for more disclosures from companies with China-based operations, which means Marvion could face extra scrutiny and compliance costs. Now, let's talk about that auditor. US law wants to make sure the folks checking Marvion's books can be inspected. If the Public Company Accounting Oversight Board can't get access to their auditor, that could lead to delisting. Most of their cash is in Hong Kong dollars, and they rely on dividends from the Hong Kong part of their company. Here's some relief. There aren't any major ongoing legal battles for them, and they comply with safety operations at their warehouses. G&A went up big time due to consulting, legal fees. They may need more cash over the next 12-18 months and plan to raise the cash from existing shareholders and institutions. Also, our subsidiaries might not be able to pay cash until debts are paid. This may limit our stock to pay dividends because most comes from Hong Kong subsidies. If they fail to comply with rules of accounting or investigations, they may be at risk of SEC deregistration in applicable trading markets. Their common stock shares outstanding is high, but the amount of shareholder of record is low. Here's the key takeaway. There are high risks associated with the market from doing business in Hong Kong. It also might be difficult to recover from judgments in the United States. Also, takeovers are hard because of Nevada business combination law. And remember, they don't plan to pay any cash dividends on their stock, so you won't get anything unless you sell. For the year 2024, revenue was 1,544,180 BD vases, $60.59,526 in 2023. But also, net loss was $70,33,663. The net loss were in a deeper hole. Cash is up with net cash coming from financing activities. General and administrative went up as well due to one-off consultancy fee, legal and professional fees incurred in relation to corporate merger. They also did a reverse stock split one for $3,000. Going concerns still exist, but as they believe they can sustain operations for at least the next 12 months. Under Chinese law, subsidiaries are also required to put some profits in a reserve fund. Also, more details are set on how the Chinese government exerts substantial influence over the manner in which they must conduct their business activities. The company has a very limited hold on their intellectual property rights. As of the data, there are 7 full-time employees in Hong Kong, and it may be hard for secondary trading to occur due to difficulty in sales and exemptions by state. If the foreign investor sells their shares of common stock, they may be subject to attacks by the PRC. Their biggest competitors are Kanyao and SF Express, and they're finding ways to work with them. This report states substantial doubt about our ability to continue as a going concern. Audit fees are much lower than the previous periods. This 10K mentions all the related party transactions, which seems like an attempt to be transparent. If the company's bank fails, the company will have up to around $100,000 in coverage. There are a few subsidiaries that the company controls operating the warehousing, logistics, etc. Tao, what's the verdict? Marvion has greatly increased revenue but also has more net loss. They can't pay dividends for the foreseeable future and have substantial amount of notes payable. It's a mixed bag. They have more revenue and also more general and administrative expenses, a high number of shares outstanding, plus several big risks related to operations in China, including cybersecurity issues. They believe that things will improve, which might be too optimistic, but they appear to be a solid warehousing and logistic player in the Hong Kong market. The company is on the right track in Hong Kong, but it appears they will require a lot more cash and management. Let me know what you think. Hit like, subscribe, and comment below.